Greetings, and welcome to the ServisFirst Bancshares second quarter earnings call. At this time, all participants are in a listen-only mode. A brief question-and-answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star 0 on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce your host, Davis Mange, IR Director. Thank you, Davis. You may begin.
Good afternoon, and welcome to our second quarter earnings call. We'll have Tom Broughton, our CEO, Rodney Rushing, our Chief Operating Officer, Henry Abbott, our Chief Credit Officer, and Bud Foshee, our CFO, covering some highlights from the quarter, and then we'll take your questions. I'll now cover our forward-looking statements disclosure. Some of the discussion in today's earnings call may include forward-looking statements. Actual results may differ from any projections shared today due to factors described in our most recent 10-K and 10-Q filings. Forward-looking statements speak only as of the date they are made, and ServisFirst assumes no duty to update them. With that, I'll turn the call over to Tom.
Thank you, Davis. Good afternoon, and thank you for joining us as we review the quarter. We were generally very pleased with the quarterly results, and of course, we have a saying that we're pleased but never satisfied with the results of the year or the quarter, and that's always true. We're never satisfied, and we think we can do much better going forward. I'll give a few overview of few of the things we're going to talk about. One of them is credit quality. Henry Abbott's going to give a review in a minute. We continue to have industry-leading credit quality, as he will discuss in a few minutes. We really don't see any issues with all the commercial real estate that you read about in the headlines. We don't see any issues with our commercial real estate book at this point. Our strong balance sheet does provide us with a lot of opportunities, and we're seeing a lot of opportunities to grow core relationships and core deposits. We don't have any broker deposits or Federal Home Loan Bank advances on our balance sheet. Very few banks can make that claim. If you include our correspondent Fed funds in our loan-to-deposit ratio, the adjusted loan-to-deposit ratio is 85% today, as the correspondent Fed funds flows back and forth between the non-interest-bearing and the Fed funds account based on the level of interest rates. So we're very pleased with a decline in our loan-deposit ratio to 85%. We did see very good deposit growth in the second quarter with good growth in core banking relationships. It was a good number. We are seeing the results of our deposit focused over the past year. Again, we focus on service and growing core deposits, not on the rate of which we pay as the primary driver. The deposit pipeline continues to be very robust today. We are pleased with where our liquidity ended up. We got our cash and short-term treasuries that now exceed $1 billion, which is a good level, and we're proud of that. On the loan demand side, we are seeing some slowdown, I guess, over the last few months as borrowers assess the economy. And again, we've kind of been a little bit more cautious than normal as we assess the effect of recent events on the economy. So, I think the whole banking industry has been a little bit more cautious, and borrowers have been more cautious. But I think we're starting to see normalization, and we'll see normalization in credit demand in the next few months. Our main focus has been on the loan repricing efforts, as Bud Foshee will discuss in more detail in a few minutes. We are focused on addressing the efficiency of our banking team. We are proud of our efficiency ratio. It was one of the industry-leading efficiency ratio, and we've reduced 11 producers on a year-to-date basis. And again, Bud's going to talk more about loan repricing, but we'll see improvement in our margin over the next few quarters as with the loan repricing continues. So I'm going to turn it over to Rodney Rushing now to give a correspondent update.
Thank you, Tom. Basically, we're very happy with correspondent division results, where we had both growth and stabilization during the quarter. Total active correspondent relationships increased to 360 banks during the quarter. Total fundings were at $1.84 billion, with a slight increase in the DDA operating balances. Biggest news from correspondent is that balances remained stable during the last 2 months of the quarter. New relationships added during the quarter were 11, 4 from Texas and 4 from Kentucky, as we continue making progress in both of those markets. Credit card revenue increased for the quarter, which Bud will expand on it here in a minute, but during the second quarter, we added 6 new correspondent agent banks to issue credit cards. 6 additional banks are in the pipeline, which should close in the third and fourth quarters of 2023, plus 5 for the first half of 2024. The Oklahoma Bankers Association added ServisFirst Bank to their list of endorsed vendors, bringing our state association endorsements to 9. New agent banks were added to the card programs in Oklahoma, Kansas, Vermont, Wisconsin, and Minnesota during the second quarter, just to show how broad and wide-ranging these state and American Bankers Association endorsements are for us. And with that, I'll turn it over to our Chief Credit Officer, Henry Abbott.
Thank you, Rodney. I'm very pleased with the bank's results and continued strong credit quality in the second quarter. The bank grew its ALLL to 1.31 of total loans in the second quarter versus 1.28% in the first quarter of 2023. This increase is not related to any specific credit, but rather a continuation of our conservative outlook as we've had a very strong quarter. We continued the trend started in the first quarter where both AD&C and the entire CRE bucket decreased as a percent of capital for the second consecutive quarter. AD&C as a percent of risk-based capital dropped from 93% at the end of the first quarter to 86%. We continue to stress and look closely at our CRE portfolio to ensure we are appropriately managing the risk. The year to date, we have not had any major shifts or deterioration. I can get into specifics in the Q&A section of the call, but we have no material office exposure. As I've mentioned in the past, we have been at record low NPAs for the past few years. Past dues to total loans were down to 15 basis points, a 3 basis point decrease from the first quarter. Net charge-offs for the quarter when annualized were 11 basis points, and year-to-date annualized, that would be 8.5 basis points, which is on par with our charge-offs for 2022 and near record lows for our bank. Over 90% of the charge-off figure for the second quarter was related to one specific C&I credit. If it were not for this one specific credit, given the recoveries in the quarter, we would have had 0 net charge-offs for the quarter. I would also note the bank has no remaining exposure to this relationship. We've taken our lick and moved on. I continue to feel very good about the markets we serve and the diverse and granular lending relationships we have at ServisFirst Bank. On the whole, I'm very pleased with the second quarter results and turn it over to Bud.
Thank you, Henry. Good afternoon. The bank made really good progress in deposit growth, liquidity, and capital growth in the quarter. Our non-interest-bearing deposits were stable in the second quarter, and we were pleased with the deposit growth in the quarter. We had a goal of $1 billion in liquidity, and with the growth of our cash and short-term treasury bills, we reached that goal. We're seeing great momentum in deposit growth. We did see some margin compression in the quarter from 3.15 to 2.93. We're assuming one more Fed rate increase for 2023. We expect the margin to stabilize and remain flat in the third quarter and begin to improve in the fourth quarter. Our loan repricing initiative is bearing fruit and will contribute to margin expansion later in the year. Examples of our repricing efforts: fixed rate loans that paid off early year to date are $174 million. Loans that have repriced are $155 million. And we have $173 million pending in loan repricing. We have $1.9 billion annually if you include normal cash flow from fixed-rate loans on an annualized basis and repricing, we will improve the rate on these loans by about 300 basis points. And our loan portfolio has a short duration. 85% of new loans are floating rate, and about 40% of total loans are floating today. We think one Fed increase of 25 basis points, we're close to neutral today with an outlook for improvement going forward. Although loan growth is flat year to date, there are a lot of maturities that are being replaced at much better rates. We continue our growth in book value per share. Bank Tier 1 leverage ratio improved from 9.91% to 10.25%. Consolidated CET1 ratio improved from 10.01 to 10.37. Our capital continues to be a strength. We saw improvement in non-interest income in the quarter, with improvement in both credit card and mortgage, and we expect continued improvement over the balance of the year. In discussing non-interest expense, we've made an effort to hold the line on expense growth in 2023. We have held the headcount flat on a year-to-date basis. While we have added a few employees in risk management, we have made reductions in other staffing. While we expect a possible FDIC special assessment at some point, we do not know today what to expect, but think it will be a modest impact on 2023 results. We have built our staffing in our new offices and do not expect additional headcount for any existing offices. Our teams are performing quite well and have grown new accounts 20% year over year. Our core expenses declined by $1.1 million in the second quarter, and we expect third quarter run rate to be in line with the first quarter. That concludes my remarks. I'll turn it back to Tom.
Thank you, Bud. As you can see from all these comments, we continue with business as usual at ServisFirst. We did open our Virginia Beach office this quarter. I was up there last week. We've got a great team there on the ground. They're doing a fantastic job, and look forward to great results from them as we go forward. So in any event, I am really proud of what our team has delivered this quarter, and they always produce what the shareholders need. So with that, I'll be happy to answer any questions you might have.
Thank you. We will now be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate that your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we pull for questions. Thank you. And our first question will come from Graham Dick with Piper Sandler. Please proceed with your question.
Hey, guys. Good evening.
Good afternoon.
So I just wanted to kind of start on the balance sheet. Obviously, deposit growth was, really strong this quarter, and, you coupled that with loans that are pretty much flat. You got a lot more breathing room on the loan-to-deposit front. Can you just talk a little bit about how you think the balance between loan growth and deposit growth will play out for the rest of the year? I know we had talked about, maybe a high single-digit number a few quarters ago, but any update you could provide on the loan growth front and then, the level of deposit growth you guys are expecting to produce throughout the rest of the year would be very helpful.
Graham, we've been cautious, and I just said that obviously we've been cautious to this date, but, we're getting more confidence, and, every day and every week that goes by, we feel better about where we are, where the economy is. We're pretty much, as I said, business as usual, so we'll resume making loans again. There is always loan demand in places like, Nashville, Tennessee, Charlotte, North Carolina, Florida, the whole state. There's always tremendous loan demand in Florida. So we can, we can find the loans to make. So, we feel good about our deposit pipeline, and we're going to start resuming business as usual. I can't, it's kind of hard to give you a number, but, our team has always produced. Whatever we need to produce, they produce. So, again, we feel a lot better about where we are than we did, at the end of the last quarter. And we feel a lot better about where the industry is today than in the last quarter, Graham.
Oh, yeah, I can imagine. I guess just framing it a different way, do you think, would it be safe to assume loan growth matches deposit growth for the rest of the year, or is there any color there you can provide?
Yeah, I think that, I guess I did a good job answering your question, obviously, if you're having to re-ask that. But I think, yeah, if we bring in a dollar of deposits, we'll probably make $1 of loans, if that's a fair statement.
Okay, great. That's helpful. Now, you did a fine job. I probably asked the question bad. All right, so then I guess just on non-interest bearing, those were, they held in a lot better than what we've seen from other banks this quarter. Any color on what you guys are doing that's driving that versus some of your all's peers? And then on the correspondent front, I think I might have heard that those balances were actually up quarter over quarter, the non-interest bearing balances. Just wanted to get a sense for if you think that trend might be able to continue in that division.
This is Rodney Rushing, Graham. Yes, non-interest bearing correspondent was up for the quarter slightly. Total fundings for the correspondent from quarter end to quarter end were down. The good news in correspondent is the last 2 months of the quarter, for May and June, the total funding in correspondent banking was leveled off. And so, all of my community banks, I think in my comments, the number was 360 total banks that we have now. Their liquidity runoff has seemed to stop. And so their balances with us has been stable for the last 2 months. So if we can maintain that for the third and fourth quarter, with the new accounts that we're opening in Texas and Kentucky and other markets, hopefully that will grow.
It's for the general bank, Graham, on non-interest bearing. I think, we are a business bank, and so we have, significant size accounts. So we could have one that goes up or down, $50 million in a quarter, and it might be at the quarter end. So we could, we might, we've held in steady, but next quarter we might be down $100 million, or we might be up $200 million at the end of the next quarter. So I can't represent, because we are a business bank, and we do have significant size customers. So it can vary, a bit, but, we had less far to fall than a lot of the older banks. I remember years ago, Harry Brock, who was the chairman and CEO of Compass Bank, he was the founder of the bank, and I was working for what is now Regions Bank. It was AmSouth Bank, and he said, "Y'all got a lot of lazy money at your bank, Tom." And I didn't quite understand what he meant, but over time I learned what Harry meant about the lazy money. And I think you've got a 100-year-old bank charter that's just they've got a lot higher non-interest bearing deposits, and they've got farther to fall than we do. So, in any event, it's probably good news for us.
Yeah, definitely. And the last question for me is just, looks like you guys added to the bond portfolio this quarter. I just wanted to get a little color on your all's decision and thought process behind that, and then maybe what rates you bought those bonds at and the duration of them, or anything like that would be great.
Yeah, Graham, it's Bud. Really, a lot of that had to do with pledging.
We didn't need to pledge anything,
yeah,
but we did. We've got it in case we need it for collateral. But we added what do we add? $350 million in
Very short.
6 months and less in treasuries.
Yeah, and the yield's 5.35, 5.40, and it reduced our average life to 3.2 years also on the entire portfolio.
A little better yield than you get at the Fed. So
yeah,
that's the logic behind it. We don't need it for pledging.
Okay, great. All right, that's it for me. Thank you, guys.
Thank you.
Thanks, Graham.
Thank you. Our next question is from David Bishop with Hovde Group. Please proceed with your question.
Yeah, good evening, gentlemen.
Hey.
Good evening.
Hey, following on that question, and I couldn't help but notice that the end-of-period balances on investment and even deposits was much higher than the average balance. Was that a function, Bud or Rodney, of some of those correspondent relationships sort of coming online later in the quarter? Just curious if there was any sort of timing around was it sort of a late quarter surge in funding growth?
It was not a late quarter surge in correspondent balances.
I know we had a large municipal deposit that came in right at the end of I don't know exactly when in the quarter. You remember, Bud, exactly? It was
20th or so, would you?
Yeah,
something like that.
Pretty late in the quarter, and it'll be here a while. And it's a municipal. A lot of the COVID money, federal stimulus money is starting to make its way down to state, local, municipalities. So that's what that affected it, Dave.
Okay, got it. And then, Rodney, staying sensitive, I know you guys always don't like to give away the plumbing in terms of the inner workings of the correspondent division. And, I know we had it on the road last month. You said it tends to remain, relatively, profitable despite, what rates are doing. But notice that the decline in third-party service charges, is that a function of, you handling, more accounts, sweeping more into the Fed service here? Maybe what's driving that down on a quarter-to-quarter basis, the third-party processing fees?
But it wasn't. I don't think it was a fluctuation or a correspondent banks. Do you know if that had anything to do with conversion or what? FRB settlement charges were down.
Yeah.
We'll have to get back to you on that. I did not see the big decline in correspondent service charges, but we'll have to look into that and just get back to you.
Okay, you can do that maybe offline.
Sure.
And then, and if you have it, just curious, maybe an update. I know you provided last quarter on the commercial real estate book, the office book. Any change there? I know it's a small part of the puzzle here, but I know the investor public's focused on it. Just any sort of inter-quarter details you can update us on.
This is Henry Abbott, and no material change. As I kind of mentioned in my comments, AD&C is down. Overall, CRE income producing is down. Specific to office, that's still around, and this is non-owner-occupied office is, only 3.5% of our total loan portfolio. So it's not a material amount. And as I mentioned, kind of CRE as a whole was down for the quarter.
Got it. Thanks.
Thank you. Our next question is from Kevin Fitzsimmons with D.A. Davidson. Please proceed with your question.
Hey, good afternoon, guys.
Yeah, good afternoon.
Just want to circle back on the margin again. So if I heard you right, what you said is you expected, it was down 22 bits this quarter, but you expect it to stabilize in third and then begin to expand in fourth. And I just want to make sure I heard that right. It seems like with one more Fed rate hike, what we're hearing from a number of banks is there'll be more margin pressure in third quarter, but probably a little less than what we saw in second, and then beginning to stabilize in the fourth. So I'm just wondering whether maybe the loan repricing coupled with maybe a little more steady balance in the non-interest bearing and the overall deposit growth is maybe stabilizing your margin a little earlier than others. So I just wanted to dig into that if that's right.
Yeah, Kevin, this is Bud. You're right. You're right on.
Okay. So, okay.
You want more than affirmation? I mean, if the NIB is stable and we're repricing loans, our projection shows that we can keep margin steady at this point, and that it'll start to expand, you know, in the next couple of 3 months, not a whole lot, but then it get into the fourth quarter, I mean, it'll start going up a couple of bips a month, and something, you know, it starts getting up to, you know, it starts clawing its way back, you know. So we think that we think the Chinese water torture is over, you know, which it has been. Chinese water torture. So we think it's over, and that we're headed in the right direction, and there's light at the end of the tunnel.
That's good to hear. Good to hear. And maybe if I could just ask about expenses, but if I heard you right, did you say third quarter is going to be like the first quarter run rate, not the second quarter? I just want to make sure I heard that right.
That's correct. That's correct.
Okay.
Yeah, we'll have to increase incentives some, so it'll be in line with first quarter.
Okay. And just more, I think you mentioned in the expense discussion comments that it was pretty limited number of new headcount, that if you're hiring in one area, you're looking to reduce, you know, like revenue producers, you're looking to reduce staff in others. And as always, the efficiency ratio is best in class. But trying to connect the dots, Tom, to your point about feeling better about loan growth and about the economy and the industry, and given that there's disruption out there, do you foresee opportunities to hire away folks? And if you're feeling better about the backdrop of the economy, might you do that sooner rather than later?
Yeah, we are always constantly talking to people, but now we've been fortunate enough to be able to hold the head count pretty much flat, you know, on a year-to-date basis. Maybe we're up 1% annualized or something like that, and you got to hire, you know, the risk management people. You know, the regulators never sleep, so we always have to be, you know, adding to staff in that area. So that's just, you know, that's just part of life, and so we have to try to look for other efficiencies. And we, you know, again, as I said, this is a year to kind of get the right people on the bus and get the right people off the bus, perhaps, and we're trying to find ways to be more efficient, because we're going to have to continue to add, you know, risk management people. So that is something we've worked hard at. We are always constantly talking to people, but we have filled out our staffing on all our existing offices. As I said, that we feel good about, and Bud said, about where we are with the staffing in our existing offices, but we you know, we hired somebody last week. I mean, you know, we hire somebody just about every week. There's a production person, the right team, we'll hire them tomorrow. So we're not, you know, we're not in a turtle mode, obviously, in our turtle shell. So we're always looking, and we're always talking, and, you know, the right group, they're welcome aboard tomorrow. So.
Got it. And one last one for me. So you meant, you know, capital's obviously strong. You mentioned that you added to securities this quarter. Some banks have indicated they're evaluating potential bond transactions where they clear the decks a little bit, be able to put money to work at higher rates, maybe alleviate the AOCI issue. Is that something that is on the radar for you, or not necessarily?
No, Kevin. We did some of that cleanup last year. I don't remember how much now, but we did a pretty good bit of that. So yeah, we don't have any plans to do that for this year.
We just think, you know, our bond portfolio is so short, we think they're just going to mature at par. They are going to mature at par. So, you know, I realize that some people have a much more difficult, you know, we have a very modest, you know, losses in our portfolio, so we don't feel like we have and we don't have a long duration, so we don't feel the need to do anything. We think, you know, if you did something, even as modest as ours is, and you booked to a $50 million loss, and then interest rates fell 100 basis points in 6 months, I'd feel a little bit foolish, you know, when we could have just waited till those bonds. I mean, I realize you're putting on securities at a higher yield, but I still think the preference is to let bonds mature at par.
No, fair point, Tom. Fair point. Okay. Thank you very much, guys.
Thank you.
Thank you. Our next question is from Steve Moss with Raymond James. Please proceed with your question.
Good afternoon, guys. Maybe just circling back on the margin here. Just curious, like, where are you seeing loan pricing these days for new production?
Yeah, new loans for June went on at 8%.
Okay.
So that's
okay.
Yeah, that's a good starting point.
Okay, that's helpful.
Well, that's a blended rate, but 85% of that is variable rate.
Okay, got you. And then in terms of just, as we think about, the loan, you guys sound a little more constructive on loan growth going forward here. You've run down your construction portfolio a bit. Curious, is that an area you expect to grow here in the next couple quarters, or, should we be thinking about more C&I or CRE weightings? Just kind of curious as to how do we think about that dynamic.
We still do have some in our construction bucket that might fund up here in the coming quarter or two. It just happened to be down, and we moved some of it to the permanent bucket, and some of it then paid off. I mean, so we've still got some room to go up in our construction bucket here, and I think we're focused on C&I customers that have strong deposits with us personally and corporate. But at the same time, if there's a good CRE project out there, it's got good loan to value, good pricing, we're taking a look at it, but we need deposits to come with our relationship.
Steve, one thing I like on the construction loans, if they're it's a multi-family deal and they're in lease up, and Henry says, well, they may want to stay with us a long time so they can borrow more eventually from Fannie, when they go permanent. But I keep thinking if they can borrow money from Fannie at 5.5 and they're paying us 8.25, how much longer are they going to want to pay us 8.25? That would, but we'll see. So that's something we can't predict is the variability on the payoffs on on that side. And of course, there's still plenty of demand in the Southeast United States for new CRE projects.
Right. Okay, great. Well, really appreciate all the color. The rest of my questions have been asked and answered here. So thank you very much.
Thank you. We really appreciate everybody joining us on the call today, and appreciate your support and look forward to the future. We're very excited about the balance of the year. Thank you very much.
Thank you. This concludes today's teleconference. You may disconnect your lines at this time. Thank you for your participation.